yeah, maybe investors like, I don't want to invest in a mortgage fund that returns 4%. I'll buy a GIC. We've always had this thesis that this space will get institutionalized. It's part of the reason why we entered it in the first place. One thing we were looking at was where do we think there are less competitive markets to compete in? Like through the family office, if we became equity managers, you're competing against like the smartest people on Wall Street who probably have an edge over you. They're in the right market. They're talking to CEOs. They've got faster data feeds, all of the high frequency stuff. We're not going to win that game. We're smart enough to know we're not that smart. I think for us, we looked at this space like, wow, there's a lot of mix out there, but presumably not that sophisticated. I mean, when you kind of dip into there, because a lot of this information is public, you can look at offering memorandums. Like, we think we can compete better in this space. And I think we've been a leader there. We built what we felt was Canada's first leading syndicate of lenders. So we had a 5-bank syndicate. We're super proud of it. We pushed all the covenant terms as far as the banks would go, and no one else had our terms. A couple of years later, everyone else has the same terms because those bankers want to make sure they can go to their other clients and offer compelling things. We've always known that our advantages would disappear over time. You like do a thing and the market's going to adapt. But I think that's just where it's going to keep going, because at some point that $100 million MIC is going to say, I can't lend at these rates. And the reason why I can't lend at these rates is I can't attract capital who will accept that return that these rates will generate. And I can't pay myself in the meantime. So absent some really wild financial engineering, I think we're pretty close to the bottom in terms of, it's not called rates, it's called spreads, before we start to see, yeah, maybe investors like, I don't want to invest in a mortgage fund that returns 4%. I'll buy a GIC. Like, we don't compare ourselves to GICs by no stretch, but when people look at their alternatives, like, well, I liked a MIC when it was returning 6.5, 7.5, 8, depending on the rate environment. I don't like it when it's doing 4.5. It's not worth the liquidity risk. It's not worth the hassle, the diligence, all that. So, a lot of people go, oh, the Americans are going to come up. And I talked to a few of the bigger funds out of the US, and you have to think of it from their shoes. Why do they want to come into Canada to buy 5% paper when you can play in the high yield bond market, which is like infinite? You don't have to originate any deal volume and potentially collect a higher coupon out of that, right? Like, there's no reason for them to come up. In our space, when we're getting higher spreads, it's attractive, right? I could see why Americans would want to come up in like 2018 and go, for the risk you're taking, you're earning an extra 300 bips. That's compelling. I'd say that gap is closed, and probably permanently. The only reason why it wouldn't be closed permanently, I think, is if we start to see some of our competitors, gate, see big redemptions, pull out of the market, all that kind of thing, then we will have more pricing power. Currently, we don't have a lot of pricing power.